it in as a work in progress because it was more of an exercise in continuity. Just like after the new government came, most of even the ministry making was, kind of an exercise in continuity. And I think this is the same thing happening in terms of budget as well. Our GDP is going at nearly 7%, which is amongst the fastest rising growing economy, a large economy of the world. The government, one major important thing here to look after is the fiscal discipline. The fiscal deficit having been pegged at 4.89% and going toward next year to FY26, slated for 4.5% in this government, at least to its credit, there is one thing. What they have promised in terms of fiscal discipline, they have maintained it. So 4.89%, which is very good. And inflation remaining in check, that means real economic growth is happening. So this will have a good positive impact on banking and finance. Growing economy means banking and finance should be doing very well. There will emerge a credit growth as and when private capex grows up, there will be credit demand growth happening. Deposit growth has been muted for the banking sector, and that is why the reason is that in the last budget, in the previous one, and to this budget also, gradually all the other instruments of investments are being made a little less attractive as compared to FD, so that FD's bank FD can also compete with the other instruments, because otherwise the banks may not be able to meet the credit demand growth. And so it looks like it's a good place for banking and finance. Infrastructure. FY23 Government of India budgeted and spent 7.5 lakh crore. FY24 it was raised to 10 lakh crore. And in the current year's budget, it is kept at 11.11 lakh crore. And so infrastructure growth has a very good spillover effect on the rest of the economy and all the building materials sectors. So I think everything related to infrastructure and capex should be, capital goods should be continuing to do well. Agri, all the measures related to agriculture that have been announced, rural housing and all the rural handouts, farmer handouts, etc. of the past continuing, I think this should revive the rural consumer growth, rural demand also, which because there was a lot of talk that, this was concerning that the consumer-led demand is not happening, whereas the infrastructure and capex demand was growing up. So this looks good. There was a concern about these lower subsidies to food, fuel, and fertilizers. I don't think that's very significant, because this is also a function of subsidies, is also a function of two things. One, if the prices of fertilizers are down because gas prices are down or something like that, then also subsidy bill can come down. Plus the government does change the subsidies going forward in the interim period during the year. So that's not very relevant. Most other sectors is a work in progress, not much impact from the budget per se. And during the Q&A, we can discuss individual sectors if it is required. So economic growth is sustained. Political stability certainly get ensured with, as Business Line called it, the BAP budget, Bihar and Andhra Pradesh. So I think that is a good thing only. And the fact that the main opposition party says that हमारे मैनिफेस्टो में से आपने तो कॉपी पेस्ट कर दिया, तो अच्छा ही है ना, अगर उनके मैनिफेस्टो से अच्छा कॉपी पेस्ट कर दिया तो आपको तो खुश होना चाहिए. So I think that is one part. But where the bad, I'm come to a little bit about taxation impact on capital markets. So STT in securities transaction tax in futures and options has been raised. This is justifiable, and I think everybody knew that this is in the coming, because the growth of retail investors in F&O segment was becoming a social concern. And RBI was flagging it, Ministry of Finance was flagging it, and SEBI also mentioned that it's no more a micro challenge, it's become a macro challenge. So I think that is justifiable. People really, the policymakers want to sort of disincentivize this. So this is okay, but more can be expected from regulators like SEBI in terms of doing this. But this is where all the good news stops. The concerns that I have is on the three aspects of the taxation. One is long-term capital gain tax having been raised from 10% for listed equities also, from 10% to 12.5%. This is a direct raise of 25%. See, the tax has gone up by 25%. It's not 2.5%. That you have to understand. And the quotable quote there was that there is an imbalance between labor income and capital income. So there are two ways to approach this. Labor income को भी तो बढ़ाया जा सकता है ना, tax paid labor income by reducing the tax on the middle class as the president was highlighting. And whereas the capital income के ऊपर में ये किया है, तो I think I mean this is where the socialist part of the government is perhaps showing its face. And when we look at capital income, we have to look at two more strategic angles. One is that the fact that equity as an asset class actually, is the risk capital coming in. No other asset class is having that risk capital, and also what will happen is that if these tax measures will affect investment patterns of households. So this is certainly discouraging. I mean, this could have been better avoided, but I think the government also has political optics to show that, okay, everybody in the stock market is making money right now. So I think that could have been they wanted to actually bring down the valuations or something like that. But not much impact as far as that is concerned in the market till now. Second is indexation benefits being withdrawn. So basically the genesis of indexation benefit was that inflation was not in investors' hand. But now what has happened is with this tax, so the taxpayers will be paying for inflation, which is they are not responsible for it and they have no control over the inflation. And look at this, right now inflation is maintained. Come look at the scenario if there was hyperinflation. So what is happening is if the asset prices are going up because of inflation, it is the investors who are going to pay for the inflation, and this is a cause for concern. I'm sure Sonanaji will be, and other speakers on taxation will be speaking more on this. And the last is about the buyback tax. That the incidence of the buyback tax being transferred to in the hands of the investors. I think, first of all, if you do a very simple chat GPT query in the top 20 economies of the world, where on earth there is something called a buyback tax? No country. What earlier originally was happening is everywhere is the same thing, that buyback tax is a capital gain being paid by the investor, shareholder who is surrendering, who is offering his shares for a buyback. No other country, to the best of my knowledge, is having anything called a buyback tax. So buyback tax itself was not good. Okay, because it is not a shareholder reward. It is also an integral part of the financial strategy of a company that it adopts. It's a part of its capital allocation. Okay, because it is an instrument through which companies can actually, give back to the shareholders the surplus, non-operational surplus liquidity that it has, which helps in improving ROCE, ROE and other ratios, which helps in improving EPS, and which also, improving the valuation of the stock. Now, this is in investors' interest, but so this should have been avoided. Then this 20% buyback tax has now been what has been announced, in my opinion, is was certainly avoidable and should be reviewed. Why? Now look at it. That first of all, a surrender, a surrender, a sale of a capital asset is being the proceeds of that entire proceed is first being taxed. So instrument is being sold and the entire proceed is treated as an income, clubbed with an income, and then the cost of it is will be, अगर आपको कभी फ्यूचर में लॉस प्रॉफिट हुआ तो उसके अगेंस्ट में एडजस्ट हो जाएगा आपका. नाउ सपोज व्हाट इफ आई एम अ वन टाइम इन्वेस्टर इन वन स्टॉक विच आई हैव ऑफर्ड फॉर, सो I mean, this is ridiculous. And then 30% tax, okay, on dividend, whereas on capital gain is 15%, 12.5% long-term capital gain. So this is looks to be a very inconsistent, and I'm sure there will be corners of concern to make the government review this. So looking at these 3-4 tax, it looks like, President, that not only the retail investors are intoxicated by the market boom of last 4 years, somewhere in our policy making process that also that intoxication has come in, so it's not good to, as I mentioned earlier, to club equity as an asset class with other asset classes, because for the growth and development of the economy, it is important that risk capital is available. And risk capital को आने के लिए दो चीज चाहिए, कुछ तो incentive चाहिए, नहीं तो क्यों आदमी कोई डालेगा रिस्क कैपिटल में, and क्योंकि किसी ने अभी लगता है सब भूल गए हैं कि स्टॉक मार्केट में रुपया डूब भी सकता है. So that is one thing. And second is, of course, it will have an impact on the way people think and invest. And so, when the going is good, looks like everything looks good. But what when the going is bad? I remember 95 to 97, 2 years, there was stock markets were going nowhere. It was complete depressed markets. The change of governments were happening, and at that time, a lot of representations went from various quarters from 95 to 97, and that was the result when 97 May the dream budget of P. Chidambaram had come. Today also everybody remembers that as the dream budget, because that was a budget in which everything that was asked for by the business fraternity as well as the capital markets fraternity that came out. So I think we need to take things very, very in a balanced manner to tax a very important asset class like equity, and even if there's a social concern about it. So to wrap it up, India growth story is a work in progress. Budgets done and dusted. Focus will come back to earnings, and valuations are high. But future looks very good given the growth-oriented and development-oriented outlook of the government of India. So I think that is good. It's a liquidity-driven rally. The flow from SIP, the flow from domestic institutional investors for the first time in history is more than the flow from foreign institutional investors. But global macroeconomic and geopolitical risks remain. So I would say the outlook is cautiously optimistic. It's a classic buy on dips market. And with this, I give it back to the President to take this forward. Thank you.
Is the risk-oriented asset. Let me correct you. The biggest risk-oriented asset is public bank deposit. You are only insured to the extent of 2 lakhs of rupees. 5 lakhs now, yes, 2 to 5 lakhs. And now let me tell you, this government was coming up with a legislation called bail-in and bail-out. Now what happens in a bail-in and bail-out, that your entire deposit is frozen for a particular period of time when there is an NAP, and it has been done in other countries also. And this particular legislation was there. It went to the select committee. one of the members of the select committee was our MP from West Bengal, and I always used to ask him this question, that is it going to come? And one fine day in the morning, he gave me a call and he said that, Mr. Khaitan, I am giving you a good news that the government has decided not to come out with this law because they felt that if they come out with this law, they will not be able to win the election. So the risk factor is not with equity only, the risk factor is also with the bank deposit, let me tell you that, and it's a greater risk. But whatever it is, I now request Mr. Surana to give his views. I'll come.
Learned President, learned Senior Vice President, we have heard their in-depth analysis of the budget, including some aspects of the taxation by our Senior Vice President, Sri Pachisia. Let me share my observations about the budget. Sri Khaitan, Sri Pachisia, Sri Choradia, Sri Jaiswal, Sri Baheti, members and friends. At the outset, I wish to state that this budget has been designed with a mind to nourish the central-state partnership, promotion of competitive federalism, and incentivizing states for faster implementation of reforms with earmarking a significant part of 50-year interest-free loan are some of the proposals to address the shifting political landscape. However, to my mind, the concern about the rising prices as well as development initiatives that could improve the day-to-day life of common people in India has not been addressed. I have a question as to whether Madam Nirmala Sitharaman presented her 7th state budget yesterday for fiscal 2024-5, surpassing the record of former Prime Minister Sri Morarji Desai, had enjoyed her budget or not. As an economist, she might have realized that core issues like unemployment, inflation, availability of more disposable income to support consumption spree and related issues have to be addressed. There is practically no change in tax rates except tinkering with slabs and marginal relief with the new regime under Section 115 BAC. Under the new tax regime, the standard deduction for salaried individuals has been increased to 75,000 from 50,000. Similarly, a deduction on family pension for persons having pension income has been increased to Rs 25,000 from Rs 15,000 if they file taxes under the new regime. Under the new tax regime, the tax structure have been modified in such a way that a salaried employee in the new tax regime can save up to 17,500 in taxes. Besides, as per proposed changes in Finance Bill 2024, the deduction against employer's contribution to pension scheme under Section 80 CCD has been increased to 14% of salary and dearness allowance for other employers as against the previous limit of 10% for other employers. However, the benefit of this amendment has been made applicable only to the taxpayers who are opting for the new tax regime under Section 115 BAC. The budget at a glance establishes that this share of the government revenue from income tax, that is on individuals, at 19% is more than what corporate have contributed, which is 17%. Therefore, there is no change in domestic corporate tax rates. The tax rates on the other countries continue to be same as in earlier years except the change in TDS rates. However, deduction of income tax at source on other income in case of companies which are not domestic companies have been reduced from 40 to 35%. A new tax TDS provision is proposed for payments made by the firms, including both partnership firm as well as LLPs, to the partners by way of salary, remuneration, interest, bonus or commission. So now any payment by a firm of the above nature exceeding Rs 20,000 shall be subjected to TDS at the rate of 10% under Section 194T with effect from 1st October 2024. Just see, the partnership firm is distributing their profit by way of salary, by way of remuneration, by way of share of profit. Still there is TDS brought in. Angel tax is a tax levied on companies that issue fresh shares to investors at a price above the company's fair market value. The excess of the issue price over and above the FMB was made taxable under Section 156(2)(7) as an angel tax in the hands of the company. The positive side of the budget is in its focus of abolishing angel tax. It will certainly encourage more investors to explore and support promising early stage ventures driving home growth and job creation. Here I may point out section 56(2)(10) is there. Though in our opinion it may not be applicable, but the disputes will again come up. And some disputes have already come up by applying section 56(2)(10), though we are confident that the interpretation may not be correct. A significant relief of reassessment and reopening of returns filed earlier years in that such cases has been reduced to 6 years as against 10 years earlier, along with concept of block assessment for all such assessments and levying tax at the rate of 60% if it is admitted in the return. If you admit in the return itself after search, the block assessment will be there and you will be paying 60% only. But if you don't admit, then 30% penalty will be there. So that at least the prosecution provisions will not be applicable. There will be no levy of surcharge. Though provision has been kept that surcharge may be levied later on, but now there is no provision for surcharge, and interest under section 234A, B and C will not be there. This will apply to the surcharge conducted after 1st September 2024. And for other assessments, reopening is limited to 5 years only. That was 10 years, that was also 10 years, if it is up to 50 lakhs. No more than 5 years. LTCG on listed securities has been increased from 10 to 12.5%, as our senior vice president said. The period for all other assets to qualify as LTCG is brought down to 2 years. Lowering of LTCG rate on sale of land, gold, unlisted shares to 12.5% in place of 20% will not be beneficial to them who are holding such assets before 1/4/2021. See, the calculation is if cost index is less than 1.8, then one is benefited. If it is more than 1.8, then there is loss. And most of the people who are selling their old properties, they will be at a loss always under the new regime. The security transaction tax on futures has been increased from 1.25% to 0.02%, and STT on options has been increased to a certain percentage. The tax on STCG on listed securities is also raised to 20%. The proposals may be a game changer in the mid-term and present a mature Indian investors' biophobia and curb disproportionate speculation in futures and options. Change in provisions for taxation on capital gain is significant, I am sure, and our Vice President has also elaborated on this issue. The amendment in buyback provisions that he has already said, taxing the whole receipt by the shareholder is not in good taste. In buyback, the company not only returns the contribution made for issue of shares, but also the accumulated profit or capital reserve share premium. In so far as distribution and treatment of accumulated profit as dividend is concerned, there can be no quarrel. But there is no justification to treat the cost of shares as dividend and treat such cost as capital loss when buyback price not only includes the accumulated profit, but also the cost paid by the shareholder. There are some important structural reforms that have been imposed as well. To reduce the number of pending cases, the monetary limit for filing tax dispute appeals before the learned tax tribunals, Honorable High Courts and Honorable Supreme Courts have been raised to 60 lakhs, 1 crore and 2 crores. Besides, Vivad Se Vishwas scheme has been reintroduced to facilitate the settlement of tax disputes and eliminate litigation. So far as the circular of 60 lakhs, 1 crore, 2 crore is concerned, the department has also issued another circular. And they more or less included everything, that these are the exceptions. So I don't know how far this will work. And then our president rightly said that they have said within 6 months we will bring some simplified tax structure and simplified tax law. This we are hearing for last about 20 years when that tax policy was being brought up, but I don't know when it will work out. In conclusion, I would like to state that proposals on direct taxes in the budget have been classified as transparency in every sphere. With these words, I conclude my address and would request Sri Sandeep Zoradia, Chairman, Indirect Taxation and GST Subcommittee, to share his observation on indirect taxes. Thank you all.
Good evening, everybody. Good evening to our Chairman, Ketan sir, Sri Pachisia Surana sir, Sri Jaiswal, Sri Bahiti, and members and friends. Thank you very much for giving me this opportunity to say a few words on Budget 2024-2025. At the onset, I would like to state that the Central Budget 2024-25 mostly revolves around the notion of facilitating employment generation and skill development with prime focus on MSME. The Honorable Finance Minister proposition aimed at simplifying the indirect tax regime, reducing compliance burden and fostering domestic manufacturing. In this context, the government has reaffirmed its commitment to further simplify and rationalize the GST structure. After the last GST Council meeting held on 24th of June, the current budget was implemented. The recommendation that was announced herein by bringing in the change in the Finance Act, this is expected to broaden its coverage and maximize benefit to both consumer and businesses. In order to promote domestic manufacturing across the range of sectors, the government introduced several measures, including full exemption of custom duty on 3 additional cancer medicines. In addition to that, changes were made in the BCD, Basic Custom Duty, on mobile phone, mobile PCBAs and chargers, which was reduced to 15%. Further, full exemption of custom duty on 25 critical minerals to encourage their processing and refining within this country. This is a very welcome aspect, according to me. To provide ease of doing business, the government has provided relief to the long-standing ask of the industry in terms of rule of origin, which has been relaxed by enabling acceptance of different type of proof of origin provided in trade agreement in order to align it with new trade agreement which provides for self-certifications. Other such measures include increase in time period from 3 to 5 years for duty-free re-import of goods exported out under warranty from India, as well as increase in duration from 6 months to 1 year for export in the case of aircraft and vessel imported for maintenance, repair and overhauling. I would like to highlight benefit on a few more issues related to indirect tax. One of the significant reform made in this regard is definitely the amendment in the mandatory ISD, that is input service distributor. It is expected that this will further streamline input tax credit distribution and enhance efficiency in managing business. At least at present, we need to ponder more into this, because it is a very important aspect of this budget. And this was troubling the industry very much. Secondly, the introduction of Section 74A is notably aiming to improve clarity and efficiency. Lastly, improvement in logistic and reduced custom-related times are set to benefit international trade by simplifying import processes. Overall, the budget is focusing on boosting the manufacturing sector in India and improving the ease of doing business as well. While the budget has set its agenda right to move towards the path of developed economy by 2047, there needs to be an alignment of incentive to create the necessary ecosystem to further boost manufacturing in India. I am sure that detailed analysis of the budget implications on indirect tax would be presented by Sri Jaiswal in course of this address. With this word, I conclude my address and would like to request Sri Baheti to share his observation on the budget.
A very good evening to all the members and esteemed experts. Thank you, Mr. Churaria, for that overall perspective insofar as the indirect tax impact out of the budget is concerned. As we know that the GST Council had met last month on the 22nd of June, when they had recommended, there were about 50 recommendations which they had made. And these recommendations were made with the triple objective of ensuring A, reduction in litigations, B, addressing industry issues, and C, some of them were trade facilitation, or I'll say compliance measures. With those 50 recommendations having been made last month, it was expected that there won't be anything big bang insofar as the budget is concerned, save and except making the legislative changes which were required to ensure that the recommendations are implemented. And precisely that's what has been done insofar as this budget is concerned. While the changes are very many, but I'll be limiting myself to the significant changes on the 3 buckets that I just alluded. So the first bucket, when I said that the endeavor was to reduce litigations. Why I say this is because of the three amendments which have been incorporated in the budget, incorporated in the finance bill. So the first is this amnesty scheme which they have introduced, where they say that any tax demand which is pertaining to the period 1718 to 2021, if the demands have been issued under section 73, so that's a provision under which demands are typically issued where the intention is not to evade taxes. It could be on account of interpretation typically. Those are the kind of demands which go under section 73. So the proposal is that tax demands under 73 without any interest and penalty, if you make payment of the tax by 31st of March 2025, then there is complete waiver from interest and penalty. They've also clarified that if by this time you've already ended up paying the interest and penalty, obviously there's no scope for any refund. And that the coverage under this waiver is not just limited to issuance of show cause notices. Even where orders have got passed, even those matters can be covered under the amnesty as long as the demand has been confirmed under section 73. So that is one where they want to reduce pending litigations by giving waiver for interest and penalty. Then a second proposal was to reduce the pre-deposit requirement for assessees to avail their right of appeal. As we know, presently under the GST law, there are two rights of appeal available, basically two different forums, where an assessee ends up paying around 30% of the disputed tax demand, or in terms of absolute number, it could be as high as 100 crores. So that's the cap. They say 30% of the disputed tax demand or 100 crores. As opposed to that, now through the legislative amendments, what is proposed is that you can avail your twin right of appeal before the two different forums by paying a maximum of 20% of the disputed tax demand, and the overall amount is capped at 40 crores. So again, they're trying to reduce the working capital load at the end of the assessee, as also give the assessee the right to appeal without shelling out as high as 30% or 100 crores upfront, even for contesting frivolous demands. And then the third proposal is, it is something akin to what has already been done in the context of direct tax, where monetary limits have been prescribed for the department to not prefer appeal before the GSTAT. Well, we know that GSTAT has not yet come into existence, but it's a matter of time. The next 6 months, we should see the GSTAT up and running. So whether it is the GSTAT, High Court or the Supreme Court, the limits are 20 lakhs, 1 crore and 2 crore. That said, one will have to take this particular clarification which has been issued through a pinch of salt, because when you look in the detail, what we see is important issues such as classification, valuation, refund, time of supply. Those have been kept outside the ambit of this monetary limit. So effectively, it may only address, I'll say, technical breaches or trivial matters, but significant matters involving classification, valuation having been left out. I don't know to what extent this will serve the purpose of reducing litigations. So these three important amendments in the context of reducing litigation. Then so far as the law is concerned, under the GST law, there were two machinery provisions, 73 and 74, for the purposes of initiating tax demand recoveries. Now, both the provisions were applicable in different circumstances. So 73 was applicable where there was no element of intent to evade, and 74 was applicable when there was an element of intent to evade. Now, the time limits under the two sections were different. Under 73, notices could have been served to an assessee up to a period of 36 months after the end of the financial year, basically the due date for filing of annual return, which is the December following the end of the financial year. From that period up to 36 months, notices basically could have been issued and had to be adjudicated. Under 74, the time limit went to as high as 60 months from the due date of furnishing of annual return. So what they've done is that, again, to rationalize these divergent time limits, they've proposed a new provision, which is 74A, wherein they say that it will be 42 months within which a notice has to be issued, regardless of whether there is an element of intent to evade or otherwise. And then within the next 12 months, such notices have to be adjudicated. So basically trying to simplify the machinery provision for recovery of taxes. So that's on 74A. Then a couple of trade facilitation measures clearly and which were much required were one in the form of there being no interest liability if you have already made cash deposits in your cash ledger, electronic cash ledger, but you delay the filing of the return. So this is something akin to an amendment which was brought about earlier to say that wherever I had SENVAT credits in my credit ledger and there was a delay in filing of return, I should have been charged with interest only on the net liability because that credit was always available. They've gone one step further to clarify that even where cash was available as on the due date for filing of the GST 3B returns, then on such cash also there won't be any interest liability. Then one significant issue which has been plaguing the industry after it was notified last year in October 23 was with respect to corporate guarantees. So insofar as corporate guarantee is concerned, you'll recall the original provision in the form of 28(2) was that you were supposed to pay, the guarantor was supposed to pay GST at the rate of 1% of the value of corporate guarantee offered or the actual consideration, whichever is higher. Now, typically,
balance amount because you're not meeting the pre-deposit. So they have come up with a clarification to say that wherever assessee intends to file an appeal, you should actually file an intimation that you want to file an appeal and deposit the pre-deposit amount. Otherwise, what happens that amount will be payable. So this is an important circular which they have issued last month, and it may also trigger a lot of recovery notices from the department side. And this is something which we have to wait and watch what will happen, how they are going to react. This is one on the pre-deposit portion. The second on 128A. 128A, as far as the amnesty scheme is there, the date, while the GST Council has recommended that the payment has to be by March 2025, they are right now silent in 128A. They have said that it is going to be a date to be notified. In most likelihood, it may be 31st March 2025, but possibly there is going to be a notification which is going to come, which will notify that date. What is also interesting over there, let's say if you have a notice initially under section 74, which is based on the premise that there is a fraud, suppression, willful misstatement, but if in an order that is converted to section 73 and the allegation is dropped of fraud, that is also something which people can go and explore under section 128A. So therefore, what becomes important, all the past litigations, controversy which you have between the period July 17 till March 2020, and importantly, if it is related to input tax credit, there are a lot of controversy where otherwise people would have been eligible for input tax credit, but they have not decided to pay since interest and penalty would have been leviable. This is the right time and window. If 128A is notified, people then explore as to whether you would like to go for it or not. What is also excluded from 128A is the option if, let's say, there is an erroneous amount of refund which has been sanctioned to you, right? That and if thereafter there is a demand, which we are seeing for a lot of companies which are under inverted duty structure, department is actually issuing notices for recovery. All those cases possibly will not go under section 128A because there is a clear exclusion. So if you have a exposure on account of tax and input tax credit, that is something which you then actually take recourse under section 128A. The next important point, which is going to be, let's say, how the litigation framework is going to be. And there is a very important amendment which Mr. Baheti also touched upon, which is that now there is going to be a common provision 74A. That is going to become effective for all demands which are pertaining to the period 24-25 onwards. So whatever is there till 23-24 will get governed by 73 and 74. So they have also made a consequential change in terms of putting the sunset clause under those provision. And 74A is going to be effective from 24-25. What is also interesting and has to be seen that in 74A, while they have tried to align the time limit in terms of issuance of notice, from a perspective of payment of penalty, still there is a differentiation whether there is a fraud and case otherwise. Quantum of penalty is also different, and the window which is also provided, if you pay the amount of tax and interest, then again the penalty amount is also different. The percentage in terms of it scales up from 15%, 25% and those to 50%. And another point which is very important in context of 74A, what is there under section 74, that if you pay any input tax credit which you have availed irregularly, right, and if you have to reverse, if there is a tax payment which you have to do and you claim that amount as input tax credit, and if the tax payment has happened under section 74, there is a clear restriction. It says that input tax credit will not be available. What they have done, and this is a restriction which comes from section 17 subsection 5 of the CGST Act, which says that any tax payment done under section 74, the credit is not eligible. They have not mentioned 74A therein, which implies apparently that, let's say, even if there is a fraud and tax payment has happened, whether the credit will be available or not. Now, having said so, there is one more restriction which is under Rule 36, which is the condition for availment of input tax credit. That condition still remains in spite of after this all amendment. While 74A is not restricted, but that provision is there. Now, this may be another area of litigation, but apparently what seems people will try and take a view, even if tax payment is arising because of fraud, input tax credit restriction will not apply. So this is another change, another important change which has to be seen how it is going to be there. Corporate guarantee is already spoken about. What is interesting that again from a corporate guarantee perspective, while they have clarified in the circular that let's say if it is for a period of 5 years, you have to pay upfront, which is something where assessee would be looking upon at thought also how this is going to be interpreted. What is also interesting that at times the corporate guarantee is provided in a perpetuity form without any time limit. What happens to those cases? How I am going to pay that amount, right? How that valuation will happen is something which needs to be seen. The another important area which they have clarified, let's say, if the assessee is eligible for full input tax credit, there is a provision under 28(2) which says that you can now follow any value which you want to follow for the purpose of discharge of GST liability. Now, there is a clarification also on this to which goes on further to say that any value which is decided which may not be 1% may be relevant for you, but this condition that let's say input tax credit is eligible in entirety has to be seen through a transaction or through an entity. So let's say if you as an entity is eligible for input tax credit in entirety, or let's say that corporate guarantee is attributable to a business and which is fully eligible for input tax credit because that is meant for taxable supply. So these are some of the important nuances which has to be seen when let's say you are trying to implement this. Beside this, there are furthermore, because as Mr. Baheti said, there are more than 50 amendments. There is one small change, let's say in terms of a new provision under section 11A, which has been sort of brought in. What has to be seen that, and which gives a power to the GST authority by way of an order or a notification which will be based on the recommendation of GST Council. If there is a liability which is because of short payment of tax or non-payment of tax, there then be an order which then be issued, because in terms of the general trade practice, industry has not been paying taxes or has been paying short amount of taxes on that. They can come up with an order and that will get regularized. This is something, a paramateria provision was also there under the erstwhile Central Excise Act in terms of 11C, wherein there were more than 100 of orders wherein they have regularized this. So this is important area to be analyzed from a perspective, let's say if you come from an industry where there are certain industry specific issues in terms of position people have taken not to pay taxes. So this is one area of representation that where you can expect a relaxation even for the past period. This seems to be limited only to the tax amount. This may not apply to input tax credit, but again this is going to be seen as to how this is going to be applied. I'm just being mindful of time because there are a number of changes. Let's say if I'm running out of time, I'm fine. Basically, I'll just cover one more point from a systems standpoint. While Mr. Choradia mentioned about the objective as to how the rate reduction has happened and the approach which they have followed, they have picked up 12 sector, right? But and then they have tried to tweak with the rates exemption which has been extended because of the sunset clause which has been there. There has been more than 107 rate changes which they have done from a customs tariff standpoint across those 12 sectors. Those all needs to be seen as to how this is going to impact which industry. There is, just from a legislative standpoint, one important change is in context of a mover provision, a bonded warehouse regulation. And this is something which is prevalent from October 2019. If you have a factory also, that can also be virtually bonded under the customs provision, which allows you to import goods duty free without payment of customs duty, without payment of GST. This is in terms of a long term deferment benefit which is available. Right now, under that provision, there are no industries which are excluded. There has been some dispute going around with respect to electricity generating company. There is a Delhi High Court decision in favor of the electricity generating company. In order to address that decision, because the rationale has been that there is no exclusion for any industry, this time in the budget they have amended section 65, which provides for mover to say that there are certain exclusions which are going to get notified. So that is another area which has to be seen and watch out as to how this is going to actually impact which set of industry. With that, I think I'll conclude my speech. Over to President, sir. To you.
Thank you very much, Mr. Jaiswal, and I must thank all the speakers. I think before we go into the question and answer session, sir, I still want to, I'm little confused about this corporate guarantee because I'll have to deal with this subject in my board meetings, which I'm going to, I've still not understood. I mean, we give corporate guarantee in courts also, and when there is a litigation, we take an injunction. Sometimes instead of cash deposit, that says that you give a corporate guarantee. Now, sometimes the corporate guarantee, and those are in relation to statutory disputes. It is not given to a corporate house. Now, in relation to the statutory dispute, what happens? I mean, what will be the percentage? Because there is no time limit until the disposal of the case, the guarantee continues. It's a continuing guarantee. Until the disposal of the case, it is continuing guarantee. Then we continue to, as you said, we continue to give guarantees in relation to import and exports and things like that. And sometimes we take an injunction that you can't enforce my bank guarantee. Now that also, you know, the litigation continues and the enforcement of bank guarantees are spoiled. We don't know the period. I mean, it can be, these are, as you rightly said, this can be for 10 years, that can be 15 years. Because no corporate guarantee can be for 5 years. I mean, you know, when I take a term loan or anything like that, it is normally until the payments are made, you know, the guarantee continues. So, we don't know the period. I mean, guarantee is given, it is not for 1 year or 2 years or 3 years. This is a misnomer that you give a guarantee for 1 year. Basically, the guarantees are given until repayment. And no period is known when the repayment will be made. How the liability is to be calculated?
So, so let me put it this way. First and foremost, let me clarify that this 28(2) applies to corporate guarantees which are typically given to banks and financial institutions.
Yes.
So, if we are to talk about guarantees that we typically give pursuant to court orders or statutory guarantees, those are typically in the nature of bank guarantees where the issuer is the bank itself, and there this provision is not applicable. So the provision applies only when a guarantee is being given to the bank, which typically is in a situation where the guarantor is related to the borrower, and to secure the borrowing facilities of the bank, the guarantor extends this guarantee to the borrower that in the event of a default, the guarantor will step in. So in those situations, this 28(2) provision becomes applicable. And there initially when this provision was introduced in October 23, it just said 1% of the value of guarantee offered or the consideration agreed, whichever is higher. Now, sir, the irony is that typically since it is a related party transaction where the supplier of guarantee is basically the guarantor and the recipient of the guarantee or the recipient of the service is the borrower. So it is between related parties where supplier and recipient are the two related parties, and the guarantee is being offered on behalf of the recipient to the bank. So invariably in these situations, there is no consideration or open market value which is available, because we are talking about related party transactions. And who else will otherwise give a guarantee for a facility which is being secured by a borrower, save and except a related party? So there initially they said 1%, but this clarification which has come, while to the extent they say that when the recipient is entitled to full ITC, we are not concerned with the value, is welcome. But the other aspect of the clarification is equally damaging. And that aspect is when they say it will be 1% per annum, effectively equating it with a repeat sort of a consideration each year, and then they go on to prescribe that it will be pro rata if the guarantee is not running for the entire year, but the guarantee is expiring in the middle of the year. So the endeavor seems to be, or the approach seems to be, to somehow recover or maximize revenue there by asking for this 1% each year, and the problem, sir, compounds because the recipient in such cases is not entitled to ITC. Whether the recipient is entitled to ITC, in any case, whatever value you agree, there is no problem. Recipient being not entitled to ITC and this 1% cost getting added on the value of the guarantee, well, it's a cost and may actually be counterproductive.
No, why I ask this question? I'm aware of this related party transaction. I'm talking of a court case where one of our client has given a guarantee in relation to the demand made by a subsidiary company. I mean, it's the holding company has given a guarantee for the subsidiary company. The subsidiary company naturally come within the definition of the related party transaction. Now, the guarantee has been given in a court proceedings. Now, if a demand has been made, a statutory demand has been, it is a guarantee in perpetuity. So, when do I make payment, sir? How do I make payment?
Absolutely, sir. Then this 1% will just keep on accumulating year after the other.
Yes.
And insofar as time of supply is concerned, the provisions prescribe that as soon as the guarantee is given, the time limit starts, it kicks in. And this 1%, so if it is for a 10-year or for perpetuity, how will one calculate?
We don't know the period because it is given in relation to the court proceeding.
Yeah.
So therefore, I continue to pay this 1%, continue every year until the proceedings are over.
Sir, as a lawyer, sir, you know it pretty well. I mean, since this is a pure valuation efflux where the value can't be determined, I think the tax itself will fail.
Because let me put it this way. Suppose I give a guarantee, the demands are set aside. You give it on a demand, and you give a guarantee for in relation to a demand, and the demand is set aside. So the bank does not pay anything out of that guarantee because the demand is set aside. What happens? I mean, I don't get any benefit. Statutory demand has been made of 100 crores of rupees on a company which is my related party, and I give a guarantee in relation to that statutory demand, and that demand is set aside.
So my take on that would be that if it is a statutory guarantee, then since it is not being given to a bank or a financial institution, the provisions won't kick in.
No, the money, the bank does not have to pay anything in the sense, the demand has been set aside.
Yeah.
Then what happens? I mean, my demand is set aside, I've given a bank guarantee in relation to a demand, but that bank guarantee got lapsed because the demand has been set aside. I mean, I just want to understand, I mean, I have to pay this
No,
GST.
No, sir, I'll again maybe just repeat one aspect of what I said earlier, is that a bank guarantee is something to which these provisions do not apply. These provisions would apply only when a corporate is giving a guarantee to a bank or a financial institution. So therefore, many of the situations that we are discussing, where say for a statutory payment, etc., a guarantee is being given, since that guarantee is not being
for the subsidiary.
True, sir. Absolutely.
I'm talking of the
Absolutely.
guarantee given in relation to a subsidiary in relation to the demand made.
Yeah.
And that demand is set aside.
Yeah, but this guarantee has to be given to a bank or a financial institution.
Yeah, it has been given to a bank and financial
So if it is being given to a bank or a financial institution, and so the guarantee was with respect to a demand which itself has been set aside, it was all along a contingent activity.
Yeah.
The guarantee itself, the nature is a contingent thing, and the contingency never kicked in, but still I am required to pay taxes thanks to the deeming provisions, whereby they deem everything between related parties to be supply of goods or services, even though not supported by consideration. And then to add to it, they say even valuation is a deeming provision. So first of all, the taxability or the charge is coming through a deeming fiction where consideration is not required. When it comes to consideration through a deeming fiction, you determine a value, and then these are the kind of consequences we land up with.
So you will have to continue to pay.
Absolutely.
Add to this.
This is one issue which I have to deal with, so I thought I'll
In fact, that is a very good question. But this is something which, in fact, let's say if you're giving a guarantee to a bank, they have in fact clarified in that recent circular by way of a illustration what Mr. Baheti also explained, that in case of a corporate guarantee, the service is providing the guarantee itself, and therefore let's say if it is not a court order, but if a guarantee is provided and the subsidiary is allowed to withdraw the amount, but the project does not start at the end of the subsidiary, then also that amounts become payable.
I'm not disputing that
Yeah,
proposition.
yeah, yeah, I
I'm
know.
only trying to say that the onerous provision, on the
totally.
justification of it,
Yeah, yeah, yeah.
I was only talking because ultimately it's a liability which I gave a guarantee and I continue to pay the cost of that guarantee in relation to a demand made, and that demand has been set aside. If the demand has been set aside, I have to bear the cost. I mean, I'm on the point of the onerous provision.
In fact, on principle basis, this point itself is challenged before court. The point is, if this is seen at a level of holdco and subsidiary, this is a part of shareholding function itself, right? As a shareholding function, I am providing this. So where is the question of service? There are some jurisprudence in context of income tax also in favor, but this is something which has to be seen.
I like the theory of mutual benefit society. I mean, I don't know whether it applies to subsidiary or not, that you cannot supply to your own members. So, when you know that the income tax, you cannot supply to your, in the service tax, that issue was there.
So,
Sir,
you are absolutely right, but what they've done in the GST regime is again through a specific provision, they have basically excluded this whole concept or argument of mutuality.
Yeah, I know. Anyway,
Principle of mutuality is also there in income tax.
I know that. It's also there in the income tax. Yeah. Anyway, we ask any person has any questions, because this is a very important budget from the perspective different announcements have been made, both in the direct and indirect. I think in any budget I've made so many provisions on GST. I've never seen it so much provisions. In fact, we had nothing to say when the budget used to come in relation to GST. This is the first budget when you have so much provision on GST. So I will start from my left side. Any questions to add from either from the direct tax or indirect tax? Anybody? None. So from very well.
The government has reduced the import duty on gold. Is there any thought process behind this reduction of gold? Because government has been accumulating gold in RBI. I just want to know whether there is any relation or there is any de-dollarization, etc. Why the government want import of gold in country
I
or
don't
keep
think
it in private hand?
Sir Beriwalji, I don't think this panel is competent to answer that question. It can be answered.
Mr. Pachisia is
But
from
Pachisia
share
ji,
market. I think
Pachisia ji
So I
let
think
them
common
say.
sense says that, more the duty, more the incidents or possibilities of smuggling is there. And the cost of goods produced by Indian jewelry makers and, that goes up, making India uncompetitive. And also the demand for gold has been going down because gold prices globally have gone up. So the demand for gold for jewelry making has been coming down. So this could have been also a demand from the jewelry industry to bring down the cost of gold by bringing down the custom duty. I think this is it's a combination of both these factors which could have behind the government's decision to reduce the custom duty on gold imports.
I think that should be the reason.
Yeah.
Gold prices were jumping day and night, and then because there was a duty.
Uh-huh.
In fact, they are collecting more and more every night.
We see that payment of salary, remuneration, etc. to a partner by a partnership firm has also been brought under the ambit of TDS.
Yes, 190/40 have been introduced.
Yes,
10% tax is to be deducted.
10% tax.
10% TDS.
10%
TDS. But I guess profit would be exempted from the
Profit is
TDS.
exempted. That's why I told you that it is in the shape of profit only. But even then they have introduced it.
Yeah, so that is, and it's from 1 rupee, the TDS has to be started
No, more than 20,000.
more than 20,000. Okay. And acha, in this current filing also, people are facing problem with regard to STCG exemption and with respect to tax 87A, the problem is there. Is it resolved or it's not clear?
37.8 will not be available.
It will not be available, no? Okay. But earlier they were accepting the filing with that
See,
provision.
all intimations are coming accepting people, but it will not be available.
Okay, 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 fine. Thank you.
Any other question on that? Thank you very much, sir, for attending, and I think.
Sir, before that, if we could present mementos to Mr. Baheti and Mr. Avi Jaiswal. Mr. Naresh Pachisia, Senior Vice President, will and Rajkumar ji to present memento to Mr. Baheti. I would request President Mr. Khaitan to present the memento to Mr. Abhishek Jaiswal, please. Request Mr. Rajkumar Agarwal, Vice President, to deliver the vote of thanks.
Shri Khaitan, Shri Pachisia, Shri Surana, Shri Choraria, Shri Baheti, Shri Jaiswal, members of the chamber, guests and friends. It is my most pleasant duty to propose a hearty vote of thanks to our speakers for lucidly explaining to us the implications and repercussions of the various proposals made in the Central Budget 24-25. I would like to extend my sincere thanks to our guest speakers, Sri Abhishek Jaiswal, partner Ernst & Young LLP, and Sri Arvind Baheti, Executive Director, Khaitan and Company, Sri Naresh Pachisia, Senior Vice President and Senior Committee Members, Sri S.M. Surana, Direct Taxation Subcommittee, and Sri Sandeep Choraria, Chairman, Indirect Taxation and GST Subcommittee of the Chamber, for sharing their valuable insights. The Central Budget 24-25 presented yesterday brought about some notable changes in both direct and indirect taxes. The significance of the budget's tax proposals is that they aim to strike a balance between revenue and revenue generation and economic growth, while also promoting ease of doing business and reducing tax litigation. Once again, I would like to thank our panelists for their insightful observations. With these words, I request you all to join me in carrying a hearty vote of thanks to the speakers with appreciative acclamations. Thank you.
Group photo. चलिए आइए अरविंद का कौन सा ग्रुप पास में आइए सर there will be no sexual harassment if you come closer. Thank you. Thank you. Thanks. चलिए सर चाय पिएंगे. Yes.